Part 3. Now we're ready to complete our balance sheet. So in part 1, we worked our way through a budgeted cash flow statement. We ended up with a cash surplus at the end. So this figure will go into our balance sheet. Given it's a surplus, it represents future economic benefits. So we're going to classify that as a current asset. Cash at bank for $15,750. Then in part 2, we worked our way through a budgeted income statement and we ended up with a net loss of $48.50. So that's going to appear, it'll be reported in our owner's equity underneath our capital and our drawings. Then I'm just going to highlight the fact that we've been issued with some closing balances, which is often the way it rolls in a budgeted question. So down the bottom here, we've got a final accounts payable balance that we're budgeting for. That's a current liability and obligation to pay your suppliers for $6,000. Accounts receivable, current asset, future economic benefit when we receive those funds sometime in the next reporting period within a year. Ditto with inventory when we sell this for a marked up gross profit, $4,800. GST can go either way, so the question will need to specify whether we have a debit or credit balance. So this one's making it nice and easy, explaining that we have a debit balance. So we'll be issued a refund at some point in the next reporting period after we've done our BAS. 1950. So back to the start of our question. Most of these points have been dealt with in the cash flow statement and in the income statement. What we're looking for are items that are final balances that we report as assets, liabilities, or owner's equity. So we work our way down on this first point, this middle point here, allowance for doc debts. We need to work out that figure. That's going to get reported underneath our accounts receivable in our balance sheet to provide relevant information to our user reports and to comply with the faithful rep QC. Okay, so how do we work this out? Okay, so it's going to be 5% of our net credit sales. So we can work out our net credit sales by going to our income statement, and we've got $38,000 minus $2,000. So let's just go over here in our balance sheet and type in $38,000, 40 minus the returns. And then we're going to multiply that by the percentage. We've deemed 5% as doubtful. So we're going to multiply it by 0.05. So in our balance sheet, we're going to report that over here. Our net accounts receivable is just going to be our balance minus our ACT deb, again, so that we're faithfully representing the amount of funds we expect to receive or not receive from our accounts receivable. Then we work our way down. These revenue items, expenses have been dealt with in our income statement. Now we're up to drawings, and we report the lot because of the entity assumption, recording owner's transactions separate from the business. So it doesn't matter that it's cash or inventory, we put in the combined amount as one entry in our OE as a negative, reducing our owner's residual claims on the assets. And we get to our purple bits. We bought some shop fittings during the year. That's a non-current asset. Our purchase price is where we start, and then we need to deduct our ACT deb so that we can report our carrying value. Now, given this is the first year we've owned the asset, we can get this figure by simply going to our income statement. So right here, we've got some shop fittings that we allocated $2,000 worth of depreciation. So that's the total amount that has accumulated thus far. So therefore, to report our carrying value, we simply go to cost minus the ACT deb. Oops. Cost minus ACT debt. All right, ditto with our vehicle. This time though, we actually had our vehicle at the start of the year as reflected by this balance sheet. So if we look here, we've got 50k and 10k in our ACT debt at the start of the year. So 50k, that's verifiable, and then we less our ACT debt. So we started with 10k, and then let's have a look at our income statement. How much do we allocate? Another 10k. And I know what you're thinking. You're thinking, that's 20k. How can we have the same amount for our ACT debt given we're using the reducing balance method? Well, you're assuming that we've had that for the full year. What if we bought the vehicle, let's say, in about August, September in 2024, and so therefore we didn't allocate a full year's depreciation. So a bit of a coincidence that we've ended up with 2 lots of 10k, but I just thought I'd throw that in there as a bit of a trap. Now, these next 3 points, we dealt with them in a bit of detail when we were doing part 2 and working out our expenses and our revenue. But what we want to report are any assets, liabilities that will roll over to the following period. So let's start with this prepaid account. So we've recorded the amount we've paid. We've recorded the amount that has been consumed. Now we've got to report the amount that will roll over to the next reporting period. So it says here that the balance for the account will be 1,200. It says that right here. So we'll get an economic benefit of that in the next reporting period. So therefore that's a current asset. It'll be used up within 12 months. 1,200. Next point, wages. Okay, so again, what we're looking for is any wages that's going to roll over to the following period. And we read in the middle here, the expected accrued wages at the end of June is 450. So this is an obligation to our staff to pay them for work done in the current reporting period. So this represents a current liability, accrued wages. 450. And then we get to the commission revenue. Again, we've got $600 owing. So based on the accrual basis assumption, we did do an adjustment for that as reflected in our income statement, but we need to represent the future economic benefit because we're going to get 600 in the next reporting period as a result of referrals or whatever in the current period. So accrued, this represents a current asset for 600. Okay. We took out a loan during the year, 40k, repayable at 8k per annum. We haven't made any payments yet, but if we look at the dates, our balance day is 30th of June. Our first payment is going to be made in less than 1 year. So let's reflect that in our balance sheet. So we've got 8,000 current. We're just going to call that loan ANZ. And the remaining 32k will be non-current because that will not be paid for a period of more than 12 months. Okay. Now the owner kicked in some capital during the year. We reflected that in our cash flow statement. There's also an impact on our balance sheet. So we look at our balance sheet at the start. We have 51,200 plus your 10 here gives you 61,200. So that goes in our owner's equity. So always check to see what your opening balance is and any additions during the year. And then we're nearly there. We had an interest expense. We're not making the payment yet, but we did do an adjustment in our income statement for the amount that was accrued. So if you look in your income statement, we had interest on the loan 600. None of that was paid. So therefore, we have an obligation. So therefore, to make that settlement, that's going to be a accrued interest expense in our balance sheet, 600. And let's check. We balance our budgeted balance sheet balances assets equals O plus L.